Today, we tackle a topic that's absolutely crucial for tax season: choosing the right tax filing status. At Safe Simple Sound, our guiding principle is to empower you to seize financial control. A big part of that is making informed decisions when filing your taxes, ensuring you're not leaving any money on the table. To help us navigate this sometimes tricky terrain, we're using the IRS Publication 17 guidelines as our source today. This article provides a comprehensive overview of the 5 different filing statuses. One of the most important things the article stresses is that understanding your filing status can drastically affect your tax liability, potentially saving you money or costing you if you get it wrong. It really highlights how marriage, divorce, or even the loss of a spouse can significantly impact your IRS filing status options. We're also going to touch on innocent spouse relief, which is crucial to know about if you're filing jointly. So, to break this down and make it as clear and actionable as possible, we'll be covering 4 key topics today. First, we'll give you a complete overview of filing status, explaining why it matters so much, and touching on those general rules based on marital status. We'll consider the factors someone should consider when making this crucial choice. Next, we'll dive into a detailed comparison of married filing jointly versus married filing separately. We'll weigh the advantages and disadvantages of each and explore the circumstances where filing separately, even with its potential drawbacks, might be the better choice. Third, we'll break down the often misunderstood head of household status. We'll clarify who qualifies, what it means to be considered unmarried, and how claiming a dependent impacts your eligibility. I know it seems like a lot, but it's important to understand the requirements. Finally, we'll discuss the qualifying surviving spouse filing status, offering guidance for those navigating the tax implications after the loss of a spouse. We'll talk about the time frame for eligibility and that dependent child requirement. Our goal at Safe Simple Sound is to make your financial journey as safe, simple, and sound as possible. Choosing the correct tax filing status is a key step in achieving that goal. So let's jump in and decode the complexities of tax filing status together. Now, let's start with something fundamental but often overlooked: your tax filing status. This isn't just a box you check on your tax form, it's actually a really important decision that can significantly impact your tax bill. Think of your tax filing status as the foundation upon which your entire tax return is built. It's the starting point that determines everything from your tax rate to the deductions and credits you're eligible for. So, what are the options? Well, there are 5 main ones: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Let's break them down a bit. The first, single, is pretty straightforward. If you're unmarried and don't qualify for any of the other statuses, this is likely the one for you. Next, we have the married options. You can file jointly, meaning you and your spouse combine your income and deductions on one return. Or you can file separately, where you each report your own income and deductions individually. It's tempting to just rush into the married filing jointly option, but the married filing separately option can provide certain protections you may need, such as shielding you from your spouse's liability in certain instances. Then there's head of household. This one is for unmarried individuals who pay more than half the costs of keeping up a home for a qualifying child or other relative. Think of it as a way to get some tax relief if you're essentially acting as the head of your family. Finally, there's qualifying surviving spouse. This is for someone whose spouse died and who has a dependent child. This status allows you to use the married filing jointly tax rates and standard deduction for 2 years after your spouse's death, assuming you meet certain requirements. Okay, so why does all of this matter? Why is your tax filing status so important? Well, it directly affects your tax rate. Different filing statuses have different tax brackets, meaning the rate at which your income is taxed will vary. It also determines your standard deduction, which is the amount of income you can shield from taxes. Beyond that, your filing status determines your eligibility for certain tax credits and deductions, which can save you a ton of money. For example, some credits are only available to those filing as head of household or married filing jointly. Ultimately, choosing the wrong filing status could mean paying more in taxes than you legally owe, or missing out on valuable tax breaks. Accurate IRS filing status is vital. Now, let's talk a little bit about how marital status plays into all of this. Generally, if you're married on the last day of the year, December 31st, the IRS considers you married for the entire year. So, even if you got married on December 30th, you'd still have the option to file as married filing jointly or married filing separately. Of course, the same rule applies to divorce. If you are divorced on the last day of the tax year, you are considered unmarried for the entire tax year. But here's where it gets a bit trickier. What does married really mean for tax purposes? Well, it includes common law marriage if your state recognizes it. It's crucial to understand your state's laws regarding common law marriage to ensure you're filing correctly. What about annulments? Interestingly, if your marriage is annulled, it's as if it never happened for tax purposes. That means you need to amend any prior tax returns you filed as married and claim the correct filing status, such as single or head of household if you qualify. So, what's the bottom line? Choose the one that will give you the lowest tax. The goal is always to choose the tax filing status that results in the lowest tax liability for your specific situation. Think about your own life. Are you single? Married? Do you have children or other dependents? Are you recently widowed? Answering these questions honestly is the first step in determining your correct filing status. What factors should someone consider when choosing their filing status? How does marital status legally impact tax filing options, and what nuances exist with common law marriage or annulments? Okay, that was a lot of information, but here's the crucial thing. Review your current marital and family situation and consider which filing statuses might apply to you. Research the basics of each filing status before proceeding. Remember, understanding your filing status is the bedrock of filing taxes correctly. And remember to be proactive about your filing statuses. Understanding your situation is paramount. Now, we're going to zero in on what happens when you're married, specifically looking at the differences between married filing jointly and married filing separately. This isn't always a straightforward decision, and understanding the nuances can save you significant money and headaches. So, whether you're newly married, have been married for decades, or are even considering separation, this segment is for you. We'll break down the requirements, the benefits, the potential pitfalls, and most importantly, how to figure out which option is best for your family. First, let's tackle married filing jointly. Generally speaking, this is the more common choice for married couples. To file jointly, you need to be legally married as of December 31st of the tax year. That's the basic requirement. When you file married filing jointly, you combine your income, deductions, and credits onto a single tax return. The big advantage here is that you often get access to lower tax rates compared to some other filing statuses. You also get a higher standard deduction, which reduces your taxable income, and it makes you eligible for a broader range of tax credits. Think of it like this. You're pooling all your resources, income, deductions, everything, and the tax system treats you as a single economic unit. This approach often results in a lower overall tax bill because the tax brackets are wider for those filing jointly. However, there's a crucial point to remember: joint responsibility. When you file married filing jointly, you are both liable for any tax owed, including any penalties or interest. This means that if your spouse underreports their income or claims improper deductions, the IRS can come after both of you. It's like signing a joint contract. You're both on the hook. Now let's shift gears and talk about married filing separately. This option is less common, but can be strategically beneficial in certain situations. You are eligible to file married filing separately as long as you are legally married. While this might seem like a simple way to protect yourself by only reporting your own income and deductions, there are downsides to consider. So, when might you consider married filing separately? One reason might be to protect yourself from your spouse's tax liability, as we mentioned before. If you're concerned that your spouse isn't being entirely truthful on their tax return, or if you're worried about potential business debts or other financial liabilities, filing separately might provide some security. Another potential reason is when adjusted gross income AGI limitations are a factor. Some deductions and credits, like certain medical expenses, are limited based on your AGI. If you file separately, your AGI might be lower, allowing you to claim a larger deduction or credit that you wouldn't be able to claim filing jointly. Here's an example. Imagine one spouse has significant medical expenses, and their AGI is significantly lower than their spouse's. Filing separately might allow them to deduct a larger portion of those expenses, potentially offsetting the higher tax rate. However, it's essential to understand that married filing separately comes with special rules. For instance, your tax rates are generally higher than when filing jointly. You also lose out on many valuable tax credits and deductions. For example, you usually can't claim the Child and Dependent Care Credit, the Earned Income Credit, or education credits like the American Opportunity Credit and Lifetime Learning Credit. The rules state that those filing separately will not be able to claim the credits or deductions. However, please see IRS Publication 503 for cases when the credits and deductions can be claimed. Furthermore, if one spouse itemizes deductions, the other spouse must also itemize, even if their standard deduction would be higher. This can be a significant disadvantage. It is important to know that if you can claim the standard deduction, your basic standard deduction is half of the amount allowed on a joint return. So, how do you decide which is better? Well, that's where the comparison comes in. It's crucial to crunch the numbers. Generally, filing jointly results in a lower tax liability for most couples. But it's not always the case. You need to look at your specific income, deductions, and credits. Consider running your taxes both ways, married filing jointly and married filing separately, to see which option results in the lowest combined tax bill for both of you. Many tax software programs offer this feature. This is especially important because even though it may not work for one person's best interests, the other person may need to file this way. Now, let's address a particularly sensitive issue. What happens if you filed married filing jointly and later discover your spouse made a mistake or even intentionally defrauded the IRS? That's where innocent spouse relief comes in. This relief is designed to protect you from being held liable for your spouse's tax errors if you didn't know or have reason to know about them. There are 3 types of relief available: innocent spouse relief, separation of liability, and equitable relief. To apply, you need to file Form 8857, Request for Innocent Spouse Relief. This can be a complicated process, so it's always best to seek professional advice if you find yourself in this situation. Finally, let's touch on community property considerations. If you live in a community property state, states like California, Texas, and Washington, you may need to take special rules into account when filing married filing separately. In these states, income and property acquired during the marriage are generally considered owned equally by both spouses, regardless of who earned it. This can significantly complicate separate filing, as you may need to split income and deductions even when filing separately. The key takeaway here is know your state's laws and how they impact your taxes. This is an area where seeking professional guidance is highly recommended. Community property states will have additional considerations to think about when dealing with tax filing, and you may need to consult a tax professional. So, to recap, married filing jointly often leads to lower taxes and access to more credits, but it comes with joint liability. Married filing separately offers potential protection but typically results in higher taxes and limited benefits. Innocent spouse relief can offer protection in certain situations. Community property laws add another layer of complexity. Here's your call to action. If you are married, I urge you to calculate your taxes both ways, married filing jointly and married filing separately, to determine which filing status results in the lowest combined tax liability. Don't just assume one is better than the other. Run the numbers. And if you're facing complex situations such as potential liability concerns, innocent spouse issues, or community property considerations, please consider seeking professional tax advice. It can save you a lot of money and stress in the long run. We've covered the intricacies of filing jointly versus separately as a married couple, and that often hinges on your specific financial situation and relationship with your spouse. But what happens if you're not married? Or maybe you are still legally married but living apart? That's where the head of household filing status comes in. It can offer some significant tax advantages, but it's important to understand the rules to make sure you qualify. Now, we'll break down exactly what it takes to file as head of household, what it means to be considered unmarried, how to identify a qualifying person, and how to calculate whether you truly pay more than half the costs of keeping up a home. So, what is head of household anyway? Simply put, it's a filing status for those who are unmarried or considered unmarried, pay more than half the costs of keeping up a home, and have a qualifying person living with them for more than half the year. Now, each of those requirements has its own set of rules, so let's unpack them. First, you need to be unmarried or considered unmarried. Being unmarried is straightforward enough, but considered unmarried is where things get interesting. This is where you might still be legally married but living apart from your spouse. The IRS has some very specific tests you have to meet to be considered unmarried for tax purposes. These tests are: 1. You file a separate return. 2. You pay more than half the cost of keeping up your home for the tax year. And 3. Your spouse didn't live in your home during the last 6 months of the tax year. It can be tough being financially responsible for a household while also navigating a marriage that is in flux. So the IRS wants to provide a tax break to help those who qualify. Think of it this way. If you're essentially running your household as a single person, even though you're still legally married, the tax code might recognize that reality. Now, let's move on to the qualifying person. This is usually a qualifying child or a qualifying relative. A qualifying child is typically a son, daughter, stepchild, or foster child who lives with you for more than half the year and meets certain other dependency tests. A qualifying relative is a bit broader and can include parents, grandparents, siblings, or other relatives. However, there are specific rules about who can be claimed as a qualifying relative, so make sure you check those requirements. Let's say your mother needs assistance paying for her living expenses. She doesn't live with you, but lives in an assisted living facility. Even though she is not living with you, she may be your qualifying person if you are paying more than half of the cost of her assisted living facility, and you can claim your parent as a dependent. This can be tricky, so it's important to review the rules carefully. Also, be aware of how dependent tax filing status impacts your ability to claim someone as a qualifying person. Remember, a person can only be claimed as a dependent once. One crucial point, especially for divorced or separated parents. Even if the non-custodial parent claims the child as a dependent under the rules for divorced parents, the custodial parent can still claim head of household status if they meet the other requirements. The third piece is keeping up a home. This means paying more than half the costs of maintaining the household for the year. This includes things like rent, mortgage interest, property taxes, insurance, utilities, and food eaten in the home. The IRS does not include costs for clothing, education, medical treatment, vacations, life insurance, or transportation. So, that new wardrobe you bought the kids doesn't count, but the grocery bills do. It's about the essentials of keeping a roof over your head and food on the table. Finally, it's important to consider special circumstances. What happens if your qualifying individual dies during the year? Or what if a child is born during the year? Or what about adoption or foster children? The IRS has specific rules for all of these situations. Also, make sure to factor in military service or even the kidnapping of a child, which the IRS provides certain accommodations. So, let's recap some of the key takeaways. To file as head of household, you need to be unmarried or considered unmarried, pay more than half the cost of keeping up a home, and have a qualifying person living with you for more than half the year. Being considered unmarried means meeting those specific tests related to living apart from your spouse. A qualifying person can be a qualifying child or a qualifying relative, but you have to meet the dependency requirements. And keeping up a home means paying more than half of those essential household expenses. Before we transition into our next topic, if you think you might qualify for head of household, I highly encourage you to take some action today. From Publication 17, grab Worksheet 2-1, Cost of Keeping Up a Home. This worksheet will help you determine if you paid more than half of all your home expenses. Then use Table 2.1 to see if you have a qualifying person. Take that information and research to a tax expert who can help you make sure you're claiming the filing status that truly fits your situation. We've covered some pretty complex scenarios already, from navigating the ins and outs of head of household status, which, as we discussed, requires understanding of the cost of keeping up a home and determining who is a qualifying person. Now let's talk about a filing status that, while born from a difficult life event, can provide some much-needed financial relief: the qualifying surviving spouse filing status. This one is, unfortunately, applicable after the loss of a spouse. It's never easy to talk about this, but knowing your options during a difficult time is incredibly important. The IRS, in a way, offers a bit of a grace period to help with the transition after such a loss. So, what is the qualifying surviving spouse status all about? Basically, it allows you to use the married filing jointly tax rates and the highest standard deduction amount for 2 years following the year your spouse passed away, if you meet certain requirements. Think of it as the IRS extending the tax benefits you had as a married couple to help you adjust financially. It is important to remember this does not allow you to file a joint return, though. So let's break down those eligibility rules. First, you had to be entitled to file a joint return with your spouse for the year they died. It doesn't matter if you actually filed jointly that year, just that you were eligible. Second, and this is key, you can't have remarried before the end of the tax year you're claiming the qualifying surviving spouse status. But here's the kicker: you also must have a dependent child, a child or stepchild, not a foster child, who you can claim as a dependent. There are some exceptions where you could claim them, but they filed jointly, had gross income over $5,050, or you could be claimed as a dependent on someone else's return. If you can't claim this child as a dependent, you cannot claim the qualifying surviving spouse status. Furthermore, that child needs to have lived in your home all year, with the usual exceptions for temporary absences, like being away at school. It has to be your home as well. The final aspect of being the qualifying surviving spouse is that you paid more than half the cost of keeping up the home. If you recall from the last topic, it is the similar requirement for head of household, where costs like mortgage, rent, utilities, and food eaten in the home add up. Now, it's crucial to understand that this qualifying surviving spouse status has a limited time frame. It's only available for 2 years following the year of your spouse's death. So if your spouse passed away in, let's say, 2023, and you meet all of the other requirements, you could file as a qualifying surviving spouse for 2024 and 2025. After that, you'd need to explore other filing statuses like single or head of household if you qualify. The dependent child requirement is a significant part of this. The child needs to live in your home for the entire year, with exceptions for those temporary absences we talked about, like school or summer camp. Think about it this way: if your child is primarily living with their other parent, even if you're providing significant support, you likely won't qualify. There are even specific rules regarding children born or who passed away during the tax year, and even special treatment if your child has been kidnapped. The overarching theme is that you maintained the home for more than half the year. So if they were born or died, you need to maintain a home for more than half the year that they were alive. The IRS requires more than half the year when they are alive. Similar to what we covered with head of household, you must be paying more than half the costs to maintain your home. As you are paying all of these costs to maintain it for you and the dependent child, it is more likely that you meet the requirements. However, if relatives are also living in the house and help pay rent, mortgage, or utilities, it could disqualify you from qualifying surviving spouse. Make sure to do the calculations. As a tangent, there are also specific rules about adopted children and foster children. For adopted children, if your home was their main home for the entire time they have been adopted or placed with you, you can claim the child lived with you for all of 2024. On top of that, if a child you qualify for has been kidnapped, you still may be eligible to file as a qualifying surviving spouse. This entire discussion is extremely important to keep in mind as you are only eligible for 2 years following the year your spouse died. So, let's recap. Qualifying surviving spouse status is a way to ease the tax burden after the loss of a spouse, but it comes with specific eligibility rules. You must have been eligible to file jointly the year your spouse died. You cannot have remarried. You must have a dependent child living with you. And you have to pay more than half the cost of keeping up the home. The most important thing is that while it provides the benefit of joint return tax rates and a higher standard deduction, it's only available for 2 years following the year of the spouse's death. Now, if you've recently experienced the loss of a spouse, please review these eligibility rules. Gather all the necessary documentation to support your claim, and most importantly, consult with a qualified tax professional. They can help you understand the full implications of this filing status and ensure you're taking advantage of all available tax benefits. All right, everyone, that wraps up our deep dive into the world of tax filing statuses. Today, we really dug into how your individual circumstances affect which filing status is right for you. We covered a lot of ground, from understanding the basics of each status: single, married filing jointly and separately, head of household, and qualifying surviving spouse, to understanding the importance of accurate IRS filing status. I think the biggest takeaway is that choosing the right status isn't just about ticking a box on a form. It's about understanding how marriage, divorce, having dependents, or sadly, the loss of a spouse significantly impacts your tax situation. That discussion about when married filing separately might actually be beneficial, even though it often carries a higher tax burden, was particularly eye-opening, wasn't it? And understanding those requirements to file as head of household can be a real game changer for many.